Welcome back to the Daily Crypto Roundup. Coming up on today's episode, we're going to break down why Bitcoin is holding near the $93,000 level, why XRP is once again leading gains across the large caps, and what's really behind the small pullback we've seen over the last hour or so. We'll look at fresh institutional developments, including major banks pushing further into crypto, why sentiment has shifted back to neutral, and why analysts are actually viewing this dip as healthy rather than concerning. We'll also cover ETF momentum, regulatory signals, altcoin performance, and what all of this tells us about the structure of the market right now. Before we get into it, a quick reminder that the XRP giveaway is due this Friday. As always, all you need to do to be in with a chance is get involved in the comments. We'll be announcing the winner at the end of the week. And if you're enjoying the show, it really does help if you can take a moment to rate the podcast 5 stars. It makes a big difference to discovery, helps push the show out to new listeners, and keeps this growing. Right, let's take a look at where the market is sitting right now. Bitcoin is trading right around $92,000, holding near recent highs after a strong multi-day move higher. Ethereum is sitting just above $3,200, remaining steady and continuing to track the broader market structure. XRP is trading around $2.24, one of the stronger performers today, and very much leading gains among the large caps. Solana is hovering near $137, cooling slightly, but still holding its broader trend. Binance Coin is trading around $900, largely range-bound. Dogecoin is sitting near 14 cents, participating in the broader move. Cardano is trading just under 40 cents, still consolidating. And rounding out the top 10, Avalanche is sitting around $14, but struggling to push out of its current position. Now, let's get into today's stories. One of the most important things to understand about today's market is that, despite the headlines and the noise, the overall tone remains constructive. Bitcoin pushing up toward the mid-90,000 region was never going to be a straight line, and that's something we've been quite clear about. When markets trend higher in a controlled way, especially after several green sessions in a row, you almost always see a short-term reset. That's exactly what we've had. Over the past hour or so, Bitcoin eased back slightly from the highs, dipping into the low 92,000 range before finding support and steadying. Crucially, this move wasn't driven by any sudden macro shock, regulatory announcement, or negative headline. There was no surprise interest rate decision, no enforcement action, no geopolitical escalation tied directly to crypto. What we saw instead was something much more mechanical. Data shows that a cluster of leveraged long positions were liquidated during that move. As price approached an area where positioning had become crowded, those overextended longs were forced out, which naturally accelerated the downside for a brief period. This is exactly the kind of move we flagged as likely when Bitcoin was pushing higher with leverage building underneath the surface. From an analytical perspective, this is not a sign of weakness. In fact, many analysts argue it's a sign of strength. When markets are able to absorb liquidations, flush out excess leverage, and then stabilize quickly rather than cascading lower, it suggests there is real spot demand underneath the price. In simple terms, buyers stepped in. This is why it's important to distinguish between a structural pullback and a breakdown. A breakdown is characterized by panic, expanding volume to the downside, follow-through selling, and an inability to reclaim support. That's not what we're seeing here. What we've seen is a relatively modest decline, followed by stabilization. Exactly the kind of behavior you expect in a market that's building structure rather than topping out. That context matters, especially when you zoom out and look at the broader picture. Sentiment data shows that the crypto fear and greed index has moved back into neutral territory for the first time in months. That doesn't mean the market is euphoric, far from it. What it means is that fear is no longer dominating behavior. Historically, some of the strongest market phases begin not when sentiment is euphoric, but when it's calm, neutral, and slightly skeptical. Analysts tracking on-chain data have pointed out that long-term holders have not been distributing aggressively into this move. Instead, a lot of the selling pressure has come from shorter-term traders and leveraged positions. That distinction is critical. Long-term holders selling tends to cap rallies. Short-term traders getting flushed tends to reset the market. At the same time, institutional involvement continues to build. One of the more significant developments today is the confirmation that major financial institutions are pushing further into crypto exposure. Reports indicate that Morgan Stanley has filed for spot Bitcoin and Solana ETFs, adding to the growing list of traditional finance players seeking regulated access to digital assets. This isn't speculative retail behavior. This is long-term infrastructure being built out. When large institutions pursue ETF products, they're not reacting to day-to-day price moves. They're positioning for sustained demand, regulatory clarity, and client interest over years, not weeks. Analysts at several investment banks have noted that ETF filings often lag market sentiment rather than lead it, meaning this push reflects confidence that crypto is becoming a permanent part of the financial landscape. This institutional momentum aligns with what we're seeing elsewhere. Goldman Sachs has reportedly been outlining its preferred crypto exposures for 2026, reinforcing the idea that large players are now thinking in multi-year horizons rather than short-term trades. That shift in mindset tends to change market behavior. Volatility doesn't disappear, but it becomes more structured. Altcoins have also been responding to this environment. XRP, in particular, has stood out, leading gains among large-cap assets. This isn't happening in isolation. XRP tends to respond early when markets begin pricing in regulatory clarity and institutional engagement, and many analysts believe that's what we're seeing now. XRP's relative strength suggests confidence is returning to assets with perceived real-world utility, rather than purely speculative narratives. Before we move on to the next stories, we are going to pause here for a quick word from our sponsors. Stay with us. Other altcoins like Solana have continued to hold their broader trends, even if they've cooled slightly in the short term. That kind of rotation, where leadership shifts without wholesale selling, is another sign of a healthy market. Rather than everything moving together in a chaotic way, capital is rotating selectively. Regulation remains a key theme, and today's developments reinforce that crypto is increasingly being treated as a legitimate financial sector rather than a fringe experiment. In India, dozens of crypto exchanges have registered with the country's Financial Intelligence Unit as part of a broader effort to bring digital assets into a regulated framework. While compliance requirements can be challenging, clarity tends to be positive in the long run. Markets generally prefer known rules over uncertainty. Globally, governments are also making their intentions clearer. Japan has publicly declared 2026 the year of digitalization, explicitly highlighting crypto and digital assets as part of its strategy. Japan has long been one of the more forward-thinking jurisdictions when it comes to digital finance, and this announcement reinforces that trend. It sends a signal that crypto is being integrated into national planning, not sidelined. At the same time, crypto's role as an alternative financial rail continues to be highlighted by geopolitical developments. Reports that donors are turning to crypto after traditional banking channels were blocked in certain regions underscore why digital assets remain relevant. Regardless of one's views on these situations, the takeaway for markets is clear. Crypto continues to function when traditional systems fail or are constrained. Another area seeing increased interest is tokenized real-world assets. Demand for tokenized gold products has risen as investors look for defensive exposure without leaving the crypto ecosystem. This tells us something important about market psychology. Rather than exiting crypto entirely during periods of uncertainty, investors are reallocating within it. That suggests confidence in the broader asset class, even when risk appetite fluctuates. One of the more interesting developments today comes out of the derivatives space, where an on-chain perpetuals exchange called Lighter has rolled out 24/5 equity perpetual trading. In simple terms, this means traders can now access equity-style derivative products on a crypto-native platform, bridging traditional market instruments with decentralized infrastructure. What's notable here isn't just the product itself, but the direction of travel. We're seeing decentralized exchanges increasingly mirror the structure and sophistication of traditional derivatives markets, while still operating on-chain. Analysts following the space say this kind of rollout is less about retail speculation and more about attracting professional and institutional-style traders who are already comfortable with derivatives but want greater flexibility and access outside standard market hours. It's another reminder that the line between traditional finance and crypto infrastructure continues to blur. Not through hype, but through incremental, practical upgrades to market plumbing. Another story worth flagging today involves tZERO, a regulated digital asset and financial infrastructure provider, which is pushing further toward what it describes as unified tokenized markets. The company is expanding its crypto-related offerings by leveraging its licensed digital broker-dealer status, with the aim of bringing tokenized assets and traditional securities closer together under a compliant framework. This matters because regulated entities don't move quickly or speculatively. When firms like tZERO expand into crypto and tokenization, it's usually because there is sustained demand from institutional participants who need compliant rails to operate. Analysts see this as part of a broader trend where tokenized assets move out of the experimental phase and into structured financial products that can sit alongside traditional markets rather than outside them. Again, this isn't a short-term price catalyst. It's a structural development that supports longer-term liquidity, participation, and legitimacy across digital asset markets. And finally, a useful reality check today on the idea of sovereign adoption. New data shows that only 3 governments increased their Bitcoin holdings in 2025, despite frequent narratives suggesting widespread state-level accumulation. While some governments continue to hold Bitcoin largely through seizures or legacy positions, the data suggests that active expansion of sovereign reserves remains limited. Analysts say this doesn't undermine Bitcoin's long-term thesis, but it does highlight the gap between perception and reality when it comes to government adoption. Rather than broad, aggressive accumulation, most sovereign exposure remains cautious, passive, or indirect. That, in turn, reinforces the idea that Bitcoin's current market structure is being driven far more by private capital, institutions, and long-term holders than by nation-state buying. In many ways, that makes the market cleaner. It means price discovery is happening through open market participation rather than opaque state intervention. And it keeps the focus on fundamentals, liquidity, and investor behavior rather than political headlines. Pulling all of this together, today's market action makes sense. Bitcoin pushed higher, leverage built up, a modest pullback flushed out excess risk, and prices stabilized. Altcoins showed selective strength. Institutions continued building exposure. Regulation moved incrementally toward clarity. Sentiment reset from fear to neutral. None of this suggests a market losing control. In fact, many analysts would argue this is exactly what you want to see. Markets that go straight up without pullbacks tend to end badly. Markets that pause, correct modestly, and then consolidate tend to build more durable trends. The key word here is structure. We did warn that a pullback was likely as Bitcoin approached key levels, and that's not because of pessimism. It's because that's how markets work. What matters now is not that we dipped, but how we dipped. And so far, the evidence suggests this was a controlled, healthy reset, rather than the start of something more concerning. Of course, volatility remains part of the equation. Crypto is still sensitive to leverage, liquidity conditions, and macro signals. Short-term moves will continue to happen. But the underlying picture, institutional engagement, regulatory progress, and structural price behavior remains intact. So as we move forward, the focus shifts from reacting to every tick to watching key levels, positioning data, and how price behaves around support. Does Bitcoin continue to find buyers on dips? Does XRP maintain relative strength? Does sentiment remain balanced rather than euphoric? These are the questions that matter. For now, today's move looks less like a warning sign and more like a reminder. Healthy markets breathe. They expand, contract, and build structure over time. And that's exactly what we appear to be seeing. Drop your thoughts in the comments, let me know what you're watching, hit like, follow, and rate the show if you haven't already. And as always, we will see you at the top.